Hello, everyone, and welcome to Thursday Talks with Chug. Each week, we cover pressing topics that matter to you and your business. I'm Ariana Gonzalez from Chug, attorneys and CPAs tuning in from our San Diego office. Please join me in welcoming partner and CPA Bhakti Suba from our Santa Clara office. Hi there, Bhakti, and welcome.
Hi, Ariana. Thank you so much for having me here.
Thank you for taking the time to be here with us today. Today, we're going to be talking about why tax planning matters. And just a quick disclaimer before we get started, this conversation is for informational purposes only. It does not create an attorney-client relationship. So if you do have any questions, please comment them below or email us anytime at info@chug.com. I want to emphasize a little bit about why we're talking about this today. At our firm, we're actively helping clients make the most of the final weeks of 2025 through smart and strategic year-end tax planning. This is the time to take control of your tax outcome before opportunities disappear on December 31st. Our teams are guiding businesses and individuals through key moves from maximizing deductions, accelerating expenses, to optimizing payroll, equipment purchases, and retirement contributions. For business owners, we're mainly focusing on aligning spending, entity structure, and cash flow with real tax savings. And for individuals, we're helping capture deductions, charitable opportunities, and investment strategies that reduce taxable income before year end. Smart planning can lower your tax bill, strengthen your financial position for 2026, and ensure you're making every dollar work harder for you. At our firm, we make sure our clients don't just file taxes, they plan ahead and keep more of what they earn. So give us a call if you're ready to get started with this. So Bhakti, can you tell us why is year-end tax planning so critical for 2025?
Ariana, tax planning is very important for any tax year. Most saving strategies must be completed before December 31st. After that date, your remaining options are generally limited to IRA and HSA contributions. Taking actions early allows you to manage income and expenses, make timely contributions, organize your necessary documentation. This is particularly critical in 2025 as several deductions are being reduced. Bonus depreciation is declining, making proactive planning essential to maximize available tax benefits.
And what are some quick tax saving actions businesses can still take before year end?
Ariana, it's never too late to start planning correctly. Businesses can accelerate deductible expenses such as rent, office supplies, repairs, or professional fees, delay their billing until January of the next year to defer income, purchasing qualifying equipment under Section 179, reviewing any payroll or bonuses before the year end can also make a big impact. For accrual method of accounting, payroll can be accrued, but make sure that it is paid within 2.5 months to be a tax deductible expense. Even small moves like paying insurance policies early can reduce the tax impact if you are using cash method of accounting.
You mentioned Section 179. Can you tell us how does Section 179 work in the year 2025?
Sure. Section 179 enables businesses to immediately deduct up to 1.22 million in qualifying equipment and software purchases. However, this benefit begins to phase out once the total purchases exceed 3.05 million. To qualify for this deduction, assets must be placed in service before December 31st, making timing a very essential tool. This deduction is specifically beneficial for small and mid-sized businesses investing in technology, vehicles, or machinery before the year ends.
What about bonus depreciation? Is that still 100% this year?
No, the rate has dropped to 40% in 2025. This means you can deduct only up to 40% of the asset costs upfront and depreciate the rest over time. The reduction makes Section 179 more important since it allows full expensing of eligible expenses subject to the limits. Combining both methods can strategically create stronger savings.
And would you say businesses should prepay certain expenses before year end, or what's your recommendation?
Sure. Yes, under cash method of accounting, you can prepay up to 12 months of expenses, like your rent, insurances, or subscriptions. and deduct them immediately this year. This is perfectly legal as long as the payment covers the services that end within the next 12 months. But record keeping is very important for this. Keep proper records showing the payment date, the purpose of the payment. That is important.
And what about year-end charitable giving? Can you tell us what's deductible?
Sure. Cash and property donations to qualified charities are deductible if made by December 31st. For non-cash contributions or non-cash gifts, you must have an appraisal report, which is for anything which is over $5,000. Donating appreciated stocks can be very powerful because you can get a deduction for the fair market value and avoid paying capital gains on the appreciation.
I want to ask about S Corp owners. How can S Corp owners reduce taxes through salary planning?
Very good question. S Corp owners are required to take a reasonable salary for their role. But any profits above that can be paid as a distribution, which avoids the self-employment taxes. Reviewing this before the year end lets you fine-tune payroll to stay compliant while minimizing the overall tax burden. Document the salary analysis carefully to satisfy the IRS rules.
What's the qualified business income deduction and how can it help?
The qualified business income deduction, commonly known as the QBI deduction, allows eligible business owners to take up to 20% of their qualified business income, reducing the taxable income significantly. However, it phases out for high earners and certain service-based businesses. Keeping income below those limits or adjusting how income is paid can preserve the deduction.
What about planning moves to optimize the QBI deduction? Are there any that you would recommend?
Yes, strategies include increasing deductible expenses, making larger retirement contributions, or adjusting the wages to balance W-2 wage limitation. In some cases, entity restructuring or splitting of separate businesses, that can help as well to maximize deduction. Your CPA can run a projection to see what combination yields the best outcome.
Wow, really good insights there. What about retirement plans? Are those still strong tax saving tools or not anymore? What do we need to know about them?
Absolutely, definitely, always. Contributing to plans like the 401ks or the SEP IRAs or simple IRAs allows you to defer taxable income and build a long-term savings. In 2025, employees can contribute up to 23,500 to a 401k plus 7,500 to catch up if you're over 50 years of age. SEP IRAs allows employers to contribute up to 25% of the compensation, which is capped at 69,000. These plans, Ariana, remains one of the most reliable tax shelters available.
Got it. So we like retirement plans.
Absolutely.
Should individuals consider realizing capital losses?
Yes. Selling underperforming investments before the year end to offset the gains. This is called tax loss harvesting. This can significantly reduce taxable investment income. Up to 3,000 of excess losses can offset ordinary income, and the unused losses can carry forward indefinitely. Just avoid the wash sale rule, which disallows the loss if you repurchase a similar security within 30 days.
We have a lot of clients who are small businesses. So can you tell us how small businesses can manage inventory for tax purposes?
Inventory management is very important for a small business specifically. How this can be done is conduct a year-end inventory count, identify the obsolete or the damaged or slow-moving items, writing them off to the fair value. This lowers the taxable income, whereas it also improves the financial accuracy. So this can give you a good start, a correct start to 2026 records for inventory management.
Going into the big topic of AR, what should businesses do with accounts receivable?
Just like your inventory, as you review, it is very important. In fact, the most important to review your receivables and write off any bad debts that are clearly which are uncollectible by or before December 31st. This creates a deductible expense under the accrual method. Also, you are required to keep documentation of collection efforts that you have made, just in case if there's an IRS inquiry.
And you often see people buying a new car at the end of the year. So can you tell us, is it smart to buy a vehicle before year-end deductions? Is this a good idea? What do we need to know about this?
Yes, it can be. It can be a smart way. Certain heavy SUVs and trucks, which are over 6,000 pounds, qualify for a full or a partial Section 179 deduction or a bonus deduction. Lighter vehicles have limits, but businesses can still qualify for mileage or lease deductions. The vehicle must be placed in service. It should just not be purchased by the year end.
Got it. What about home-based businesses? How can home-based businesses maximize deductions?
The home office deduction allows you to claim a portion of home expenses like your utilities, mortgage interest, insurance, repairs, based on the square footage used for these businesses. It must be a space which is regularly used and exclusively used for business. There's a simplified method also. The simplified method allows $5 per square foot up to 300 square feet. So even modest setups can yield meaningful savings.
Wow, really important things to consider
Mhm.
there. So, are there state-specific year-end moves to consider? I know we have offices all over the world, so what do we need to know about this?
Yes, it's very important since all states do not follow the federal rules. For example, California limits Section 179 to 25,000, and it doesn't conform to the federal bonus depreciation. State tax brackets or credit opportunities that can differ, widely. Reviewing the state's conformity rules ensures that the federal strategy doesn't create, unexpected state tax costs.
Absolutely. And if you are watching this and have questions about this, feel free to reach out to us. We would love to guide you on it. So, how can owners balance cash flow with year-end spending?
Everybody wants a good cash flow. The goal is to spend strategically, not just to, spend and reduce taxes. A $10,000 purchase can save you up to $3,700 in taxes if you're a high tax bracket. Plan purchases that you truly need, equipments, marketing, or tech upgrades that support the next year's growth, rather than just buying for a deduction. Tax savings, I believe that they should be aligned with a sound financial decision.
Great advice. So, should taxpayers make estimated payments before year end, or should they just wait?
Ariana, this question comes up so often. If you expect that you will owe more than the withholding cover, making the fourth quarter estimated payment before December 31st can avoid the underpayment penalties. There's a safe harbor rule. The safe harbor rule generally requires paying 100% of the last year's taxes. For higher tax income earners, it's going to be 110%, or it's 90% of the current year's. A small top up now is going to be definitely cheaper than the IRS interest and penalties that come up later.
Absolutely. And how can charitable giving be made more strategic?
Donor advice funds. They're a great way of, to bundle charitable giving. You can donate a lump sum amount now for an immediate deduction and then distribute to charities over time. Donating appreciated stock instead of cash provides a bigger benefit. You'll get the full deduction and also you'll avoid the capital gains on the appreciation. For large givers, grouping several years of donation into 2025, that can help, exceed the standard deduction threshold.
Wow, really interesting perspective. Thank you for sharing that with us. I want to ask you one more question. When should somebody meet with their CPA for year-end planning?
Now, ideally by mid-November, this leaves, time to make payroll adjustments or process retirement contributions or may complete, major purchases before the year-end deadlines. Waiting until December, often limits what can still be done. A proactive meeting gives you time to run projections and act before the window actually closes.
Wow, thank you so much for all this wonderful advice and all of your insights today, Bhakti, and covering the importance of tax planning with me. I do really appreciate your time. Thank you, everybody, for tuning in. This brings us to the end of our conversation. Thanks, everybody, for joining us today. Again, a special thank you to you, Bhakti. To stay up to date, please subscribe and follow us on Facebook, LinkedIn, and YouTube. Let us know what topic you want to see next, and make sure to join us next week for more pressing topics that truly matter to you and your business. Until next time, stay safe and take care, everyone. See you next
Thank
time.
you.